Everyone talks about SPY and QQQ, but there's one ETF that offers a stronger long-term growth outlook than SPY and far more diversification than QQQ. And yet, almost no one is talking about it on YouTube. Today, let's break down the iShares Russell 1000 Growth ETF, ticker symbol IWF. If your goal is to build long-term wealth, supercharge your investment growth, and keep your portfolio well diversified, here are three powerful reasons why IWF deserves a spot in your portfolio. Number 1. Long-term track record and massive size. IWF isn't just another trendy ETF. It's been around since May 2000, launched right after the dot-com bubble burst. It's weathered crashes, rallies, recessions, and recoveries, and it's still going strong. Today, it manages over $110 billion in assets, ranking among the top 15 ETFs in the world. That's larger than big names like GLD, VGT, or SCHD. This kind of scale brings serious advantages: deep liquidity, tight bid-ask spreads, and the confidence of institutional trust. Today, more than three-quarters of its holders are institutional investors across more than 1,400 institutions. Plus, its expense ratio is just 0.19%, slightly lower than QQQ's 0.20%, making it a cost-efficient choice for long-term growth investors. Number 2, strong long-term growth performance. IWF has delivered stellar performance over the past decade. Its 5-year annualized return is 17.92%, and over 10 years, it returned 16.96%, clearly outperforming SPY's 13.78% and closely trailing QQQ's 18.60%. But here's where it gets interesting for long-term, consistent investors. If you had started a $10 per day DCA strategy from the market bottom in GFC on March 9, 2009, your IWF portfolio would now be worth $190,449. According to Testful.io, a fantastic free tool for testing investment strategies. That's $45,000 more than SPY's return, and surprisingly close to QQQ's $234,000, with slightly lower volatility and better diversification. The compound annual growth rate, CAGR, for IWF over that stretch? 18.90%, ahead of SPY's 16.64%, and just a few steps behind QQQ's 21.73%. Number 3. Broader, smarter. Diversification QQQ is undoubtedly the king of tech-focused growth. It tracks the NASDAQ 100 index, which includes the 100 largest non-financial companies listed on the NASDAQ stock exchange. But this comes with two major limitations. It holds only 100 companies, and it completely excludes the financial sector. More than 60% of QQQ is allocated to technology stocks alone, making it highly concentrated and vulnerable to sector-specific corrections. In contrast, IWF tracks the Russell 1000 Growth Index and includes over 400 companies. You still get the major tech names, Apple, Microsoft, NVIDIA, but also benefit from exposure to growth leaders in other sectors, like Visa and Eli Lilly. That means IWF gives you meaningful allocation to financials, healthcare, industrials, even real estate. This broader diversification helps reduce concentration risk and makes IWF more resilient during sector rotations, especially when tech takes a breather. And there's more. According to ETFRC.com, 24% of companies in the S&P 400 Mid-Cap Index and 1% of companies in the S&P 600 Small Cap Index are also included in IWF, but are completely absent in QQQ. This gives IWF an additional edge: exposure to earlier stage growth stories, companies that could become the next NVIDIA, Tesla, or Palantir before they hit mega cap status. Think about it. If you could go back in time and buy NVIDIA stock at just 3.5 cents in 1999, that single decision could have returned nearly 5,000 times your money. IWF doesn't just give you today's leaders, it offers a chance to hold tomorrow's giants early. Whether you're a long-term investor, a DCA strategist, or just looking for a more balanced way to capture U.S. growth, IWF might be the most underrated ETF in your portfolio. If you found this helpful, drop a like and let me know in the comments. Are you adding IWF to your watch list? And don't forget to subscribe for more simple, smart investing breakdowns right here on Dollar X Dollar.